If you're looking to buy a business this year, you might be wondering what makes up a good deal. What is the deal when you're looking at it? You should say, I should buy that one and I should buy it now. Well, there's a lot of confusion out there on what makes a good deal, and I actually teach on this subject, and we spend quite a bit of time inside of our group talking about it. So in today's video, I'm going to give you the 8 key factors, the key criteria that you need to look through when you're analyzing deals and know when they satisfy that criteria, it's a must that you must buy it. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner or a W-2 employee looking to get out of the rat race by buying a profitable business, you are in the right place. Please subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when new content comes out. All right, let's do this. Now, we're going to talk about the 8 criteria. Now, they're not necessarily on 1 through 8 order, but they're kind of order of importance. And I'm excited to do this because it's something I actually constantly talk to my insiders group. It's called Business Acquisition Mastery. If you want to know more about it, please let us know. We have over 110 of the best buyers out there actually looking to buy deals, and we're looking to close about 18 to 24 deals this year. So here's what we talk about, and here's the criteria. Number 1, strong and consistent cash flow. This is a quantitative measure. Now, what is strong and consistent cash flow? A lot of business owners and sellers don't really do a good job keeping up with their financials. So we really try not to rely too much on the interim financials, the profit and loss in the balance sheet. And sometimes they give it to us in accrual, sometimes in cash. We don't really know. So it's hard to trust interim financials. So we try to get tax returns. Now, when I talk about strong and consistent cash flow, I want to see positive cash flow at the end of every tax return. Positive cash flow to the tune of 10+%. Because if I know that we're looking at a strong cash flow like that, the add backs are going to make that even better. So let me give you an example. So if you're looking at a business that is doing consistently 200,000 plus in net income per the tax returns across multiple years, I know that I'm probably going to squeeze another $150,000, $200,000 on seller discretionary earnings that are legit, that are approved by the banks. That puts me in the realm of $400,000 SDE. I know that at 3 times that I can actually get this deal funded by any lender, so long as there is strong and consistent cash flow. Now, here's the thing that you need to understand. Not all industries are alike. There's some industries that have cost of goods sold, which means they have to carry inventory. There are industries that are professional services. They don't have a cost of goods. So you got your net revenue minus your discounts equals your net sales. There's nothing in between. So it's professional services, for instance, gonna have a higher payroll as a percentage of the revenue, but that's okay. But if you know the metrics, it doesn't really matter. Is the first thing that we look at is strong and consistent cash flow. That will never go away. You cannot talk yourself into a deal. You don't want to fall in love with the deals. I tell my students, fall in love with the process, not the deals, because the deals will come. If you hang around long enough and if you work like the way we tell you in our group, you're going to have consistent deal flow. Deal flow is not always the issue. It's knowing when to pull the trigger on the right deal, because when the right deal does come, and it'll come to you, you got to move sometimes within hours. There are 15 good cash buyers for every deal out there. If somebody tells you otherwise, they're sorely mistaken. I'm an insider. I'm an M&A licensed advisor and business broker. So I got deals on the market myself. I know the metrics. So that's number 1. Number 2, clean financials and accurate records. That kind of goes with number 1. Now, somebody can give you the interim financials even on a cash basis, right? Although I personally prefer accrual. I want to look at a business on an accrual basis on accounting, because we recognize the revenue when it happens and we recognize the expenses when they happen. So when they actually do that, we don't have lumpy revenue and expenses, but it does produce AR and AP, accounts receivable and accounts payable. Why is that important, you may be asking? Because we have to know what the working capital is, your current assets or your current liabilities, things that a lot of people don't think about, we think about. Especially when you're looking at the bigger deals. And we actually specialize in the lower middle market, those between market valuations of 1 to 20. We don't really look at Main Street deals. We don't look at laundromats. Those, to me, we want real bona fide businesses where you can actually walk into the operator with 10 to 15 employees, that sort of thing. right, with intellectual property. So the cleaner financials, the larger the business, the better the chance you're going to have cleaner financials. What do cleaner financials look like? Well, we're talking about um, they actually run it on accrual, but they can actually produce cash. So I want accrual-based P&L balance sheet across all fiscal years. And I know that when I look at their cash-based financials, they're actually going to tie to their tax returns, but we're going pretty close. And there's a way to reconcile your cash-based tax returns, whether it's 1120S or 1120, into your cash basis financials. If I'm going a little too deep in this, is because it's necessary that you understand this part. There has to be a story. It has to make sense. It has to tie. We are in the business of tying up to source documents, making sure that those source documents are telling us a real story, because it's not that we don't believe the seller, but we don't believe the seller right away. We want to make sure we get evidence, trust but verify. So I want to have tax returns. I want to have interim financials so I can look at the correlation between the two, is if it makes sense to us. Now, there are sellers that decide not to pay themselves a salary and they have an 1120S, which is a small corporation. Well, that's a big no-no. Why are they not paying themselves a salary? If you have a business that is producing $1 million or more of revenue, you got to have the owner need to be an officer, and officer compensation is kind of a key thing. So it's a red flag when I don't see officer comp. If it is a business that is making a lot of money and there's no officer comp, but there's nothing to add back, well, why is not? When you come in as a business owner, you're going to have a salary. There's the law, is the IRS doesn't like not collecting payroll taxes, and the subject of this is beyond the scope of this point is clean financials. Number three, high recurring revenue and high customer retention. This is becoming a bigger and bigger deal. You don't want the kind of business where you don't know what's going to happen. So people, private equity groups, family offices, and the real institutional buyers, the ones that are doing roll-ups, the ones that have very successful business models that are expanding across the country, they are looking for sticky revenue, and they're willing to pay a premium for it. That's why SaaS, software as a service, and a bunch of other industries that have that sticky recurring term up, pest control, accounting services, and the like. Anything that produces sticky revenue, where the lifetime of a customer is so much bigger than the cost of acquiring a customer. Your life LTV over your CAC. Some of the things that I teach is I love sticky revenue. That's the holy grail of mergers and acquisitions. And private, as I said, private group equity groups are willing to pay a premium for them. Like, are there long-term contract subscriptions? When I see a business and I tell my students, look, I'm looking at a business, I'm always asking, okay, give me about, are you stuck? Do you know what's the best price to pay? Are there any customer concentration issues? How do you know? Should you look at interim financials? Should you look at tax returns? When do you reach out to the lender? When do you get a letter of support? Do you have a personal financial statement? And on and on and on. These are questions that I'm sure you have, and how to put actually a deal together. I'm here to help you. Reach out to me. Drop me a comment below. Connect with me. Send me an email. My email address is above and below. Just connect. My team will be willing to give you a complimentary call and just kind of get you where you need to be, even if you don't work with us. Let's connect. Um, actually, customer concentration. No, not only do you have higher revenue, recurring revenue, and customer retention, you don't have customer concentration issues. So you don't want to have one customer with 10% or more of the revenue. And we always reason, what happens if the bigger customer goes away? Are we going to be okay? Now, so long as the biggest customer is 10% or less, we should be able to be fine. Now, should you look away, or should you just dismiss businesses that where one customer may have 20% revenue more? I'm actually looking at deals today inside of our group. We analyze about 10, probably between 8 and 10 deals a week. We have about 40 deals, and we start to see a lot of commonalities among some industries. Now, there are some industries that are inevitable. They're going to have one customer that has 20% or more. Now, how do we mitigate the risk? There are ways and there are tricks that we use inside of our group as when we're buying them. How to protect, how to hedge our bets with the sellers, protect the buyers. I advocate for the buyers inside of our business acquisition group. So I hope that makes sense. High recurring revenue, high customer retention. Now, if a business gets 100 clients this year, and next year 50 of those clients are gone, but that's only a 50% retention rate. It takes a lot of money, time, and effort to produce a customer. So we want to make sure that that customer is going to stick around a long time. That's why you have to really look at the model. I always ask my students when we bring a deal, and we have our weekly M&A calls 2 hours at a time, and they're busy beginning to end. I just say, hey, look, so what's the deal with the business? How do they make money? And if the business cannot be explained in 30 seconds or less how they make money, you got yourself a problem. It should be the way that a seller can explain their business. It should be going up an elevator 3 floors in about 20 seconds and tell you this is how we make money. So understand how they make money. It's not about the cash flow, it's how the money is made, and can you replicate that? Number four, defensive market position with a strong USP. What is a USP? Is unique selling proposition. It's not just that you're looking for a business to buy. You want to make sure that a business to buy has a defensive market position. Now, I like some businesses that have a higher barrier of entry, whether it's licensure, whether there is equipment that you got to have, because the problem is a lot of people want to leave corporate America and want to start a business, and it takes a lot of money to start a business. And if you have a business there's a higher barrier of entry, which means that there are more things that you need to do, whether you have to overcome licensing issues or equipment, and you have a business that has all of those things, that has been producing revenue for 20 plus years, and it has something so unique about them, whatever it is, that makes them in the top 3 of their marketplace. Their brand, they're a recognized brand within the marketplace, and they've done so because they built a moat around the business that is defensible, that nobody's going to come and take. And there's a reason they've been in the top 3 for 20 years. You don't have to even tell. That's why this isn't a criteria. So, and you can't just buy a business because they just, when an industry is a fairly new industry and there's not a lot of players around, and they come to you just because you happen to be in an industry, that's good until the industry begins to mature. And then what? Right? And then new players begin to come into the business. Then how do you defend yourself? Right? How do you build a moat, a castle? Right? And from medieval times, right? How do you protect your business from being taken over? All right. So number five is growing or stable market. As I alluded before, you want to be in a market that is going places. Now, 25,000 units is what I say. And we have research tools that allow us to do that. So we have a business that they're in that industry, in that 6-digit NAICS code, so 4 digits SIC code, that has at least 25 of those, 25,000 of such businesses around the country. That tells me there is a resale value, and it tells me that it's a strong industry. Those two things. What happens if you buy this business, you double it in revenue 5 years, and then you hold on to it for 10 years, and you want to either buy other ones? Well, there will be plenty of units, or you want to divest, you want to sell it, you build it, and you build it with systems, and you turn the seller discretionary earnings to a whole nother level. Then that's the case, right? So you can do that because you can sell it to other people. If a business is so unique that there's nobody else doing it, then don't buy it. That's my advice. All right, so that was number 5. Number 6, owner's involvement in transition plan, SOPs, and documentation. Now, owner's involvement in the transition plan. Is the owner going to stick around to help you, give you what it's on their head onto paper? Because here's what happens when a lot of people buy a business: is the seller walks away, and there's no way how to, you haven't done no documentation, no ways to do invoices, no ways to do AP, no ways to buy inventory, right? No ways to hire employees, no ways to market. There's no paid advertising, there's no policies, there's nothing. You want policies and procedures in place, and if they're not in place, your job is to have the owner stay post-close to help you build those things. Some businesses fall apart after the owner leaves. I've seen it happen. If the business relies too much on the current owner, that's a problem. Your job is to mitigate it. Now, if you bring a business in which the owner is a largely absentee, they have a GM, and they have everything fully documented with gigantic terabytes of document and processes, you need to pay attention, and that's really a good thing for you. 7, fair market value. Now, you're going to have sellers, and that usually happens when you have off-market conversations. Just like when you ask somebody how much your house is worth, and they'll say, oh, it's worth $1 million, but I just bought it last year for $500,000. Well, a lot of people have this sort of delusional idea what the business is worth. It's like the house is worth, right? That's why you need a professional like me to tell you. And there are tools, there are processes that we take the businesses to come up with what we call the opinion of market value. We buy businesses on market value, not asset, not distress, not inventory, no gimmicks. There are formulas that are acceptable in the M&A industry that we use. And you got to arrive at a fair market value. Well, what is a fair market value? Well, beauty is in the eye of the beholder. Now, if there's a lot of competition, you're going to have to bid a little higher. But you need to understand one thing is, whatever you do, we're gonna give you the value range. We teach our students how to actually get the value range, and you're gonna have a ideal offer, which is going to be less than what you can compete at a higher offer. You're going to have a value range. That value range hinges primarily on the debt service coverage ratio. We want 1.5 or better. Sometimes we've gotten deals at 2.5 times. If there's more competition, you're going to have to fall back to somewhere between 1.5 and 2. And that's okay. But depending on the model and all the things that I talked about, it may be okay. You do not want to lose a deal because you're squabbling over whether it should be 1.75 and you believe that you should get it at 2 times, and it's just beyond the scope of this, but trust me. All right, so last but not least, minimal red flags and deal killers. You might be able to get a deal under contract, and then what? It falls apart in due diligence. You got to check for everything. That's why you need a strong deal team. You need a strong due diligence partner. You need all kinds of people surrounding you and helping you. Okay, so you need due diligence, a partner, a CPA, EA. You need attorneys. You need M&A advisors. You need lenders, and you need me. So hopefully that helps you. If you want to buy a business, you need to work with us. For a limited time, I'm giving away two of our most popular tools. One is the Deal Analyzer 2.0. This is a tool that allows you to calculate pre and post debt service cash flow, ideal debt service coverage across multiple years using financials provided by the seller. And other criteria like break-even point, the average 3-year SDE, how to know what a multiple to put on, and a bunch of things. You just basically plug and play. It's an Excel workbook. I built it over a long time, and I want to give it to you because you watch my channel, my videos. And also the other one is the buyer's checklist, which is a 6-page document that we use inside of our group. It basically guides you. It's like a punch list on everything that you need to do when you're doing due diligence, when you're buying a business. Those are my gifts to you. Go ahead and download them.